Thank you for taking the time out of your busy schedule today to watch the presentation video on United Urban Investment Corporation's financial results for the 44th fiscal period ended November 30th, 2025. My name is Batai, President and CEO of Marubeni Reed Advisors, the asset management company of United Urban. We would like to express our sincere gratitude to our unit holders and other parties concerned for their continued support of United Urban. This financial results presentation video was created using generative AI. We will continue to strive for the efficient operation of United Urban by actively incorporating evolving digital technologies to enhance the accuracy and timeliness of information. Now, let us proceed with the financial results explanation. The Bank of Japan has been gradually raising its policy rate since July 2024 to escape deflation and normalize its monetary policy. In December 2025, it raised the rate from 0.5% to 0.75%. Despite the weak yen and rising commodity prices, the Japanese economy is gradually recovering due to a pickup in capital investment and personal consumption, as well as an improvement in the income environment driven by corporate wage increases. The real estate market is also showing generally stable trends. Office vacancy rates are below 3% in central Tokyo and below 5% in major cities such as Osaka, Nagoya, and Sapporo. Residential occupancy also remains stable, supported by solid demand. Furthermore, retail facilities are also maintaining solid revenue, benefiting from increased economic activity and inbound tourism demand. For hotels, while concerns have arisen regarding the future impact of the Chinese government's advisory against travel to Japan issued in November 2025, occupancy rates remain high, particularly in urban areas, and domestic real estate rents are generally trending upward. In the 2025 stock market, the Nikkei stock average reached a record high in the 54,000 yen range at the beginning of the year and has continued to set new highs. Meanwhile, the J-REIT market initially trended weakly due to concerns over the rising interest rate and inflation, but gradually recovered in the latter half of the year. Amid this environment, United Urban's unit price recovered early around summer 2025 and has been stable with a NAV multiple exceeding 1. As such, we implemented public offerings in November for the first time in 6.5 years. Our unit price has remained stable since December, and we will continue to strive for sustainable growth going forward. First, I will explain the progress toward the medium-term growth strategy announced by United Urban in January 2025. Please see page 3 of the material. United Urban's investment strategy is to pursue sustainable growth and maximize value for our unit holders. As basic policies for our 3-year medium-term growth strategy spanning 2025 to 2027, we had set 3 initiatives: asset replacement, revenue growth, and cash allocation, and a target of annual DPU exceeding 8,000 yen. We are pleased to announce that we have raised the annual DPU target to more than 9,000 yen based on steady progress in each initiative. Regarding asset replacement, we have achieved 62.4 billion yen in replacements to date and will continue replacing assets at an annual rate of 20 to 30 billion yen for the remainder of the 3-year period. Furthermore, we have added external growth to our basic policies, and we will continue to consider public offerings while carefully assessing market conditions. On top of that, we will execute strategic cash allocation as the disposition of Shinsaibashi Yopa Hankan is expected to provide stable DPU for the foreseeable future. We will allocate the proceeds from the property sale to growth investments in new properties, as well as value-add investments totaling approximately 15 to 20 billion yen over the next 3 years, thereby strengthening our future revenue base. I will explain in more detail later. Please refer to page 4. First, we will explain the progress of our asset replacement plan. We had planned to implement 60 to 90 billion yen in asset replacements over 3 years starting from the 43rd fiscal period. Currently, the total value of assets scheduled for disposal by the 48th fiscal period is approximately 62.4 billion yen, reaching the target level. Gains on sales are expected to total 14.4 billion yen, which will be allocated in its entirety to unit holder returns. Additionally, with an acquisition pipeline of approximately 60 billion yen, We will continue to strategically replace properties while considering market conditions, primarily focusing on those with profitability concerns, with the aim of enhancing the quality of our portfolio. Proceeds from the sale of Lazu Musashikasugi disposed of in December 2025 and App Re-Ray, Shin Ogi scheduled for disposition in April 2026, will be allocated to property acquisition funds. Meanwhile, the proceeds from the sale of Shinsaibashi Opahan Kan, which will be disposed of in phases starting in June 2026, are slated for use in value-add investments aimed at improving future revenue. Please see page 5. I would like to reiterate our explanation regarding the disposition of Shinsaibashi Opahan Kan. Announced on September 29, 2025. The sale price of this property is expected to be 43.1 billion yen, with gains on sales of 21.1 billion yen. The property will be disposed of in 6 phases over 3 years, starting from the 46th fiscal period, with the final disposition scheduled for the 51st fiscal period. The gain on sale realized in each phase will be allocated to DPU for the fiscal period in which the disposition occurs. Furthermore, until the 51st fiscal period when all handovers are completed, United Urban will receive a total of 1.4 billion yen in rental revenue for land based on its land ownership ratio to maintain portfolio yield. We aim to strengthen our future revenue base by securing sale proceeds and rental revenue for land over the long term to boost DPU, while utilizing the sale proceeds for value-add investments aimed at improving revenue. Please refer to page 6. Regarding internal growth to enhance revenues, as a result of continuing rent increases for existing properties under an inflationary environment and asset replacements, profit from rental activities increased by 6.7% year-on-year. While increased hotel rental income driven by expanding inbound demand continues to be a growth driver, other factors such as rent increases for logistics facilities and call centers also contributed to the growth in profit. However, we anticipate that the momentum of hotel rental income growth will slow to a more moderate pace after the 45th fiscal period. Therefore, as part of our initiatives to increase future revenues, we will pursue qualitative improvements to the portfolio, strengthening future underlying earnings capacity by implementing value-add investments in existing properties, in addition to acquiring properties through public offerings and enhancing profitability through asset replacement. Please refer to page 7. As explained on page 6, we plan to implement value-add investments totaling 15 to 20 billion yen by the 51st fiscal period when the handover is scheduled to be completed, with the aim of improving future revenue and property value. These will be funded primarily by the proceeds from the sale of Shinsaibashi Opahan Kan, which amounts to approximately 20 billion yen. While some construction projects have already commenced or are being finalized, we are setting a target ROI of 10% or higher for implementing value-add investments. Based on this target, we are carefully selecting properties where such returns are expected and scrutinizing the details of the construction work. Please refer to pages 17 and onward for details on value-add investments by asset type. Next, I will explain external growth. Please refer to page 8. The red line in the graph shows the trend of United Urban's investment unit price, while the thin orange stair-step line represents NAV per unit. Based on our medium-term growth strategy, we improved portfolio profits through asset replacement and actively returned gains on sales to unit holders, resulting in an increase in annual DPU from over 8,000 yen to over 9,000 yen. As a result, since the end of September 2025, when the annual DPU target was announced, our unit price has been stable with a NAV multiple exceeding 1, and we conducted our first public offerings in approximately 6.5 years. Going forward, we will accelerate initiatives to enhance unit holder value by adding external growth for scale expansion and value-add investments as growth investments to our medium-term growth strategy. Please refer to page 9. This page summarizes the properties newly acquired through the public offerings conducted in November 2025 and their effect on our portfolio. We acquired a well-balanced set of properties, including those that significantly exceed the implied cap rate and offer growth potential and inflation resilience, alongside properties contributing to portfolio stability. Furthermore, DPU increased by 1.1% and LTV decreased by 0.9 percent points as a result of accretive capital increase. Additionally, the expansion of unrealized gains has significantly improved NAV. We have achieved growth without diluting unitholder value through capital increase. Please refer to page 10. This page provides details on allocation of cash raised through property sales, public offerings, borrowings, and other means. We implemented a buyback of Treasury investment units in the 43rd fiscal period when United Urban's investment unit price was weak. However, at the current level where the unit price exceeds a NAV multiple of 1, we will allocate funds to growth investments such as property acquisitions and value-add investments in existing properties. Furthermore, we will distribute all gains from property sales and continue to actively make distributions to unit holders. Please note that the figures stated for the 45th and 46th fiscal periods are current estimates based on transactions for which the details are already decided, such as acquisitions and dispositions, and are subject to change. Please refer to page 11. The annual DPU for the 43rd and 44th fiscal periods combined was 8,152 yen, a 7.7% increase year-on-year, achieving the initial target of over 8,000 yen in the medium-term growth strategy as planned. Due to the effects of asset replacements and improved profitability of existing properties, the annual DPU forecast for the 45th and 46th fiscal periods combined is 9,150 yen. Going forward, we will strive to maintain DPU levels exceeding 9,000 yen. Please refer to page 12. Here is the summary of the financial results for the 44th fiscal period. Due to the effects of asset replacements and the return of gains on sales, DPU reached a record high of 4,142 yen, an increase of 132 yen compared to the previous period, and an increase of 42 yen compared to the forecast 6 months ago. During the period, we implemented asset replacements through the acquisition of 3 properties worth 14.36 billion yen and the disposal of 3 properties worth 10.76 billion yen. Alongside improved yields, we made progress in improving the quality and rejuvenating our portfolio through significant improvements in average building age, while realizing 1.22 billion yen in gains on sales. The overall occupancy rate of the portfolio at the end of the period was 99.2%, and property management continues to perform well. Please refer to page 13. We will now explain the main factors behind the period-on-period change in DPU for the 44th fiscal period. The DPU for the 44th fiscal period reached a record high of 4,142 yen, an increase of 132 yen or 3.3% compared to the previous period. This marks the 8th consecutive period in DPU growth. Profits from newly acquired properties in the 43rd and 44th fiscal periods contributed 149 yen. Furthermore, gains on sales in the 44th fiscal period were 1.22 billion yen, an increase of approximately 0.7 billion yen compared to the gains on sales of 0.52 billion yen in the 43rd fiscal period, contributing to a 229 yen increase in DPU. On the other hand, the decrease in profit from rental activities related to disposed properties had a negative impact of 60 yen. For existing properties, factors contributing to the decrease included a negative impact of 102 yen due to the timing of receiving settlements for properties with variable rents and a negative impact of 84 yen due to increased interest payments. Next, please refer to page 14. I will now explain the main factors driving period-on-period changes in the business forecast for the 45th and 46th fiscal periods. The DPU for the 45th fiscal period is projected to reach a record high of 4,550 yen. Profits from properties acquired in the 44th fiscal period and properties acquired in December 2025 through a public offering are expected to contribute 285 yen. Furthermore, existing properties are expected to contribute 392 yen, including a 355 yen gain from cancellation penalty income for Shinsaibashi Oppa Honkan, which will serve as the main factor for significantly boosting DPU. The DPU for the 46th fiscal period is projected to reach a new record high of 4,600 yen, although there are such negative impacts as 391 yen from the lack of the one-time cancellation penalty income for Shinsaibashi Opahankan, 161 yen due to the timing of annual settled variable rents for existing properties, and 135 yen due to increased interest payments. These are expected to be covered by the gains on sales of Shinsaibashi Opahankan, which will amount to a positive impact of 770 yen. Next, I will explain internal growth by type of use. Please refer to page 15. This page shows the management status of hotels. For the 44th fiscal period, both ADR and RevPAR reached record highs, driven by strong inbound demand. Domestic accommodation demand is expected to remain strong, supported by Japan's inbound tourism policies. However, concerns about over-tourism and soaring accommodation costs in some regions suggest future RevPAR growth will be moderate. The graph on the upper right shows the trend of RevPAR by region for variable rate hotels. RevPAR in the Osaka area rose significantly during the 44th fiscal period due to the effect of Expo Osaka, which commenced in April 2025. Although RevPAR in the Tokyo metropolitan area decreased period on period due to seasonal factors, as it peaks in March and April due to the cherry blossom viewing season, it increased year on year. Meanwhile, tensions between Japan and China stemming from diplomatic issues persist, leading to a decline in Chinese visitors to Japan. However, as the proportion of Chinese group guests staying at hotels owned by United Urban is not particularly large, the impact is limited at this point. We will continue to closely monitor trends in inbound accommodation demand amid uncertain global conditions. Please refer to page 16. We will now explain hotel rent revenues and the GOP ratio to sales and by hotel type. As shown in the graph on the left side of the page, annual rent reached a record high in line with the increase in RevPAR. This was driven not only by rent increases in the metropolitan area, particularly in Tokyo, but also by rent growth in regional areas, including Osaka. Looking ahead, we anticipate another record high as the momentum for RevPAR growth is expected to continue. The graph on the right shows the trend in the GOP ratio to sales. Since the recovery of the hotel market in the 39th fiscal period, the GOP ratio has improved due to rising ADR that exceeds hotel operating costs, contributing to increased rents. Page 17 provides examples of and future plans for value-add investments in hotels. Please take a look later. Please see page 18. This page shows the management status of office buildings. The office market remains strong, maintaining a high occupancy rate of 98.7% at the end of the 44th fiscal period, as shown in the line graph at the top left. Although large tenants vacated during the 43rd and 44th fiscal periods, agile leasing enabled us to secure new tenants quickly, sustaining high occupancy. The right side of the page shows an example of the renovation of common areas in the SS30 office building in Sendai City. As a result of the renovation, it has maintained high occupancy and the average rent within the building is steadily increasing. Please see page 19. This page shows the status of office rent revisions and the rent gap. As shown in the rent increase-decrease graph on the left, we achieved rent increases exceeding the previous period for the 44th fiscal period by leveraging high occupancy against the backdrop of rising office demand. We successfully secured rent increases at the time of tenant replacements and lease renewals for many properties through meticulous market analysis, negotiations based on rent appraisals, and accurate identification of needs for increasing floor space. The graph on the right shows an expansion of the rent gap, reflecting the robust office market, where market rents rose significantly. Market rents increased notably in the 6 central wards of Tokyo, and with market rents also rising in the Osaka area, the rent gap for regional properties has also widened. We will continue to actively pursue upward rent revisions. Please see page 20. This page shows the management status of retail properties. The occupancy rate at the end of the 44th fiscal period reached 99.3%. We continue to maintain high occupancy by capitalizing on recovering tenant appetite for opening stores and actively replacing tenants. Since many retail properties have relatively long lease terms, we are leveraging the inflationary environment to maximize rents by conducting tenant replacement and rent increase negotiations through methods such as renegotiating fixed rent increases and introducing variable rent. Furthermore, as multiple major tenants will reach lease expirations and rent renegotiations will be coming up in the next 7 fiscal periods, we will focus on replacing tenants, introducing variable rent, and renegotiating rent increases. Page 21 provides examples of and future plans for value-add investment for retail properties. Please take a look later. Please see page 22. This page shows the management status of residential properties. Residential properties also maintain high occupancy rates and stable management. Rental demand has increased in recent years amid rising condominium prices and reduced supply, leading to rising rents, particularly for family-type units. Rents increased by 10.6% upon renewal, continuing the upward trend. Furthermore, during lease renewals, the proportion of units where rent increases were implemented rose to 42%, with rents increasing by 4.7%. In the current inflationary environment, we anticipate rent for residential properties will continue to rise for the foreseeable future. Page 23 provides examples of and future plans for value-add investments in residential properties. Please take a look later. Next, I will explain our financial management. Please refer to page 24. As shown on the upper left of the page, we raised 22.1 billion yen during the 44th fiscal period. Amid rising market interest rates, we are focusing on cost control by shortening loan terms and increasing the proportion of variable rate funding to suppress funding costs. Following the public offering in December 2025, total asset LTV reached 44.4% and fair value LTV reached 34.9%, maintaining a certain level of acquisition capacity. Regarding the impact of rising interest rates, the latest business forecast announced assumes policy interest rate hikes in December 2025 and June 2026, as shown in the lower right of the page. We will continue to strive to reduce the risk of rising interest rates through flexible funding and maintain a stable financial base. Finally, I will summarize our ESG and climate change initiatives. Please refer to page 25. While we previously set a medium-term greenhouse gas emissions target for 2030, we have formulated a new medium-term target for 2035 as we already have a clear outlook for achieving the original target. We have formulated a decarbonization roadmap toward our achieving net zero by 2050 and are steadily advancing our ESG initiatives. Please refer to the appendix for details. This concludes my presentation. Details regarding the financial results, business forecast, and management status are summarized in the appendix. Please review them as well. Thank you very much for your attention.